Hello students, welcome to my class. This is Professor Vincent Usaya and this is part 4 of chapter 10 presentation. Chapter 10, auditing the revenue process. We left off at the inherent risk assessment. So what are we talking about here? Remember in the previous chapter we talked about the inherent risk. The question is, what is an inherent risk? These are risks by nature that are just there. There isn't that much anybody can do about those risks in terms of the potential risk of misstatement. Now, so let's take a look at some inherent risk factors. Now, the question is, why are we interested in this risk as auditors? We need to assess them. We need to understand them, we need to assess them in order for us to plan the nature, timing, and extent of our testing. So take a look at the first one. Here are some factors. Industry-related factors. So these are factors that are just in the industry. There isn't anything anybody can do about it. Let's take a look at the second one. The complexity and contentiousness of revenue recognition issues. What does that mean? There are some companies that are operating in some special industries whose revenue recognition process is just complex by nature. An example would be if you are in the long-term construction business and you have a contract for 5 or 7 years, you have to use the percentage of completion method in recognizing revenue. Unlike if you are selling stuff at Walmart, you know, very simple, straightforward. Customer come in and buy, you debit cash, and you credit sales revenue. Simple. So Walmart doesn't have to deal with any complexity of revenue recognition issues. So what is the point? The point is, as auditor, we need to assess these risks and do something about it during the course of doing our audit. Now, let's take a look at control risk. What are control risks? As you know, here we are talking about internal control measures and procedures that the company put in place. So as auditors, the question for us is, are these controls actually effective? Are they actually working? So we have to assess the control risk, the risk that the controls would not be able to detect or prevent misstatement during the course of the employees doing their work. So for us to do that, we have to understand and document our revenue process based on a reliance strategy. Reliance strategy meaning what? We are planning to rely on the control to do what they are supposed to do. Then, if that is the case, if we are using the reliance strategy, then we need to plan and perform tests of controls on revenue transaction. Meaning, we need to test those controls to see whether they are actually working or not, since we are planning to rely on them by way of doing less work. Then, of course, we need to set and document the control risk for the revenue process. So, understanding and documenting internal control. Remember, we are required, GAS requires us to not only understand the internal control, we also have to document it. Now, the best way of doing that is go through the 5 components of internal control. Number 1 being control environment. This is usually done as an overall entity basis, meaning our focus is on revenue. However, the control environment is usually done on an overall entity basis, because the control environment is set the tone for how serious internal control is being taken for the whole organization. Then the second one is the entity risk assessment process. We did talk about that. Then the control activities. What kind of, we need to understand and document the internal control. What kind of control activities does the company have or put in place? So we need to have that understanding. What kind of procedural manual do they have? What kind of narrative decisions do they have? So on and so forth. Then moving along, information systems and communication. What kind of information systems does the management put in place to make sure that every transaction is properly captured and every transaction is properly recorded in accordance with that? As auditors, we need to have an understanding of the information systems and communications. Then lastly, we also need to know how the company is monitoring their controls. So that is the 5th component of internal control. Now, moving along, by the time we decide to rely on the internal controls, we now have to plan and perform tests of control to see whether those controls are actually effective. Now, the methodology of doing that, we have already discussed all this extensively in the previous chapter. So we set and document the control risk. Here are some control activities and tests of controls of revenue recognition. What are some of the assertions? Occurrence. Do the transactions actually occur? Which transactions are we talking about here? Of course, revenue. Are they complete? Is every transaction recorded? Authorization. Were they properly authorized? Accuracy. Is revenue recognized accurate? So here we are talking about classes of transactions and events for the period under audit. Cutoff. Was cutoff properly done? The classification, are they properly classified? So we have to go through all of this. So now, take a look at some example of tests of controls for revenue recognition. All right, we did talk about this in great details in previous chapter. You can use those that knowledge in terms of taking a look at some specific controls for revenue recognition. All right, so let's take a look at one or two examples here. Take a look at this example, authorization. Goods, ships, or services performed for a customer who is a bad credit risk. Do we have proper procedures for authorizing credit and shipment of goods? So we need to review the client's procedure for granting credit. So listen to this very carefully. As auditors, when we review the client's procedures for granting credit to customers, we find out that that procedure is basically non-existent. In other words, the client don't follow due diligence in approving credit to customers. The question is, why should we care as auditors? The problem is the accounts receivable. Because if the customer or the client have $200 million in accounts receivable, and by extending credit to every Tom, Dick, and Harry, then it is not likely that they are going to be able to collect much of that money. So the question is, how much provision are they making for accounts receivable? So if they have accounts receivable of $200 million and they make allowance for $10 million, okay, allowance for that full account, and they recognize $190 million as net realizable value of accounts receivable, as auditors, that might be a problem for you. You can ask them, wait a second, you cannot say that your accounts receivable or your potential receivable is $190 million, considering the fact that you don't have a proper credit approval in place. It is likely that a lot of your customers is not going to pay. The percentage of uncollectible might have to be backed up. So that might be an issue of contentment between the company and the auditor. So here that is one of several tests of control that the auditor might want to look into in terms of testing the effectiveness of internal control relative to revenue. So, moving along, occurrence of revenue transaction. Why should we care? We do care because if the transactions really don't occur and the revenues are recorded, then obviously revenue will be overstated. Take a look at number 1 or 2 that they have here. Sales to a fictitious customer. So the company can just sell goods, not necessarily sell goods, but on paper, sell goods to a customer that is really not in existence in order to beef up their sales. So that would be clearly a misstatement of revenue. So as auditors, we need to know whether the revenue transactions actually occur. Completeness of revenue transaction. Is every revenue transaction recorded? As auditors, we need to know what kind of controls does the company have in place to make sure that every revenue transaction is properly captured and recorded. All right? Authorization and accuracy of revenue transaction. Are these accounts receivable properly authorized? Are these transactions actually accurate? As auditors, we need to test those controls in place to make sure that these assertions or claims are valid. Moving along, cutoff and classification of revenue transaction. What are we talking about here? Are revenues actually recorded in the proper accounting period? Are the transaction properly classified? Here are some tests of controls for cash receipt. Alright? So again, we are not going to go through this in great details because we have already talked about this issue extensively in previous chapters. You need to use the skill set from those chapters and apply them to chapter 10. So I just want to go through one with you. Take a look at this in terms of test of controls for cash receipt transaction. Occurrence: cash receipts recorded but not received or deposited. So it's possible that the company received cash, but the cash doesn't find its way to the bank. How? Because somebody might be stealing. The question is, does management have controls in place to prevent that from happening? So that is one example of a test that the auditor can perform in order to make sure that those controls are actually working or not. Now, occurrence of cash receipt transaction. Again, this is another assertion of claim relative to cash receipt transaction, all right? Completeness. Again, we are going through the same management assertion. So as auditors, we need to know whether completeness of cash receipt and authorization of discounts were properly done. Accuracy of cash transactions. Were these transactions actually accurate? Were they properly processed? Were they properly reconciled on a periodic basis? Are bank statements reconciled on a monthly basis? So on and so forth. So those issues or those claims needs to be in order. Cutoff and classification of cash receipt transactions. When you receive cash, the question is whether the cash is actually applied to the proper period. So if you receive cash on December 28th and you apply it on January 2nd, then the problem is accounts receivable is going to be off because that cash should have been applied on December 28th for that particular year, not the previous year. Control activities and test of controls relative to sales returns and allowances. So this will be a nice cutoff point. We will continue from this point in part 5 presentation.